As far as the election goes, I think it's going to be the most consequential election of my lifetime because we now have irreconcilable differences between the two sides.
There's very likely a risk that we see a flip in terms of what people's intuitions are in terms of equity market performance, where we could see equity markets show some slowing in response to a Trump election and be buoyed by a Harris election.
Well, the U.S. presidential election is today. Stock markets are rallying this morning with the S&P up 1%, Nasdaq's up 1.4%, Bitcoin's up 3.5%. Gold is relatively flat. What will markets do the day after the election? We'll find out with our next guest, Bob Elliott, CIO and CEO of Unlimited. Welcome back, Bob. Good to see you.
Hey, thanks so much for having me. Happy election day. Even
happy election day. Yeah, well, I'm up north, but for the folks down south, for my friends down south, get out and vote today, and we'll see what happens with the markets tomorrow. Let's talk about what's going to happen to the markets this week. So here's a quote from JP Morgan, reported by CNBC. So JP Morgan believes that if Trump wins, steel stocks will likely do very well. And if Kamala Harris wins, then green energy stocks might do very well. So this is according to JP Morgan analyst Bill Peterson. A Harris victory would likely imply the status quo for green policy spending. However, with a more hawkish view on foreign policy targeted around strategic sectors like energy transition and AI. Meanwhile, a Trump 2.0 scenario will likely bring increased use of tariffs on Chinese and European imports, among others, with the first 100 days focusing on executive authority related to energy and deregulation, along with the phased introduction of tariffs. So steel for Trump, green energies for Kamala. Which sectors do you think will do well in either scenario?
Well, I think both of those are good representations of which sectors will benefit from the different from either candidate being elected. I think one of the challenges and opportunities right now is that because it's a 50-50 call, even though the sectors that would benefit are kind of obvious to some extent, the election of one candidate versus another will likely create a pop in those stocks. So if you have a strong view on one candidate versus another, you can go with what is essentially what sounds like a consensus beneficiary because it's probably not fully priced in. I'd probably widen out the aperture also a little bit from those recommended sectors. I think the deregulation part of things is particularly important when you think about things like energy or financials, which would really benefit from a Trump administration taking a very, very open stance when it comes to regulation versus a Harris administration, which would likely create a much tighter set of constraints on those entities.
I wonder how energy stocks would do, though, under a Trump victory. Now, presumably, energy could do well in either scenario if we have geopolitical tensions escalate in the Middle East. So that's dependent on foreign policy. But from my understanding, Trump has been a little bit more pro-drilling, correct?
That's right. So you just in this sort of circumstance, you got to separate out essentially those companies that are exposed to the end price action and those companies that are basically support the pipeline for actual production. And it's really in those production elements of the supply chain that are necessary to do the drilling. They're likely to be most benefited from a Trump election.
What about the stock market overall? Is that dependent on the election at all, or more so on the economy and the outlook for growth into the next quarter?
Well, I think if you look back through time, the thing that mostly drives what's going on with the stock market is the macroeconomy and, Fed policy. But this is a circumstance where there are relatively divergent views in terms of fiscal policy that could come ahead. And in particular, a Trump administration at an overall stock market level that's going to pursue a tariff increase, which is likely to be it's essentially a middle class tax hike, in contrast, favoring essentially a tax cut for higher income folks, and that composition is pretty bad for demand, and particularly bad for consumer staples and consumer oriented stocks. And so I think you add that up, combined with the fact that that's likely to increase inflation and challenge challenge the Fed to run tighter monetary policy than expected, it's very possible that we're going to see actually a weaker stock market over as if a Trump election gets digested by the market, which is a little counterintuitive given the fact that many people are connecting the stock strength to tax cuts.
What about short-term volatility here? Take a listen to what Ray Dalio, CIO of Bridgewater, told CNBC.
As far as the election goes, I think it's going to be the most consequential election of my lifetime because we now have irreconcilable differences between the two sides. We have a situation where the first question we'll ask is, will we have an orderly transition of power? The fact that it is possible that election results may not be accepted. That's quite something. Nowadays, what is a clear winner? I don't know. But we have also behind that a win-at-all-cost mentality. In other words, we're getting to the point where the rules are of secondary importance relative to winning.
There certainly could be a fair amount of uncertainty. It really comes down to how ambiguous the outcome is. Certainly, if you look at the polling, it's basically 50-50, but almost always there's a polling error of between 3 and 5%. So we could have a range of outcomes ranging from, on a knife's edge to a relatively clear and decisive victory from one side or the other, depending upon, where the polling error is sitting. Odds are, I think, more likely than not that we're going to have a decisive victory and that the polling error is going to be relatively substantial. And so that should reduce the risks of volatility. Look, if you look at how the markets are pricing in the volatility risk, of course, there's a 1 or 2 day volatility risk. But, the markets are pretty sanguine about the long-term volatility risk of a transition of power here. And I think are making a pretty big bet on the institutions operating effectively to do this transition.
Markets are up today, like I said at the beginning. Are markets pricing in a certain victory from either Trump or Harris?
Well, certainly not pricing in certain victory on one side or the other. And I think what we've generally seen is that the stock market has gone up as Trump's odds have increased. There's other things going on there, including stronger U.S. stronger U.S. economic data, as well as easier Fed policy. But the connection generally is pro-Trump to pro-equity rally. I'd caution folks, having traded through the 2016 election, which was a meaningful surprise, the betas to Trump odds going up was actually stocks going down. And then in the end, we saw a flip of that dynamic. Essentially, people were reversing reversing the impact of the decision when the actual outcome occurred. And I think we very well might be seeing that set up here today, where the macroeconomic consequences of a Trump presidency are likely negative for stocks, even though stocks are trading favorably on Trump odds going into the election.
How are they negative for stocks if Trump wins?
Well, Trump's election is the primary policy is basically two primary policies, which is to implement a substantial middle class tax hike through tariffs that is inflationary, which will force the Fed to have to run tighter monetary policy than they otherwise would. In addition, the idea of closing the borders and engaging in anti-immigration actions is also inflationary. And the tariff policy is unlikely to create sufficient income to offset the lost income from the extension of the TCJA. And so you put that all together, that would lead to substantially larger deficits and the risk of rising interest rates. That combination of things is not a very equity positive combination of dynamics, even though there's sort of this general sense that Trump will be more pro-business.
What about if Kamala wins? Now, remember, Harris wants to increase taxes, especially capital gains taxes. I'm not talking about unrealized capital gains taxes. I'm just talking about normal capital gains taxes. Those will be raised if she wins. Now, assuming Congress approves, of course. So wouldn't we get a short-term sell-off if everybody just wants to lock in capital gains taxes before the new tax codes roll in?
Well, I think it's very important to recognize that while Trump's policies can be implemented without the authority of Congress or agreement of Congress, the proposals by the Harris administration are meaningfully constrained because they need congressional agreement, because they're basically all elements of the purse, so to speak. And so as a result, the odds that you're going to get divided government are quite high on a forward-looking basis Harris with the Harris election. And so the odds that those policies will actually get implemented are pretty low. And so odds are that won't be a meaningful influence on the equity market in the near term.
If we do get a divided government, would that be more bullish or bearish for stocks going into 2025?
My guess is that that's going to be more bullish going for stocks for a couple of different reasons. One, it depends, of course, exactly on, who is elected on the presidential side. But Harris victory with a divided Congress is likely going to be the best circumstance for stocks because you're not going to have that substantial hike in inflation and middle class taxes in the short term that are associated with the implementation of tariff policy.
Now, this week, we also have an FOMC decision. Now, I'm looking at the CME Fed Watch tool. There is a 99% chance that rates will go down to 450 to 475, which implies a 25 basis point cut. Could markets be wrong?
No, the Fed is essentially certain to cut 25 basis points. And we as we saw even back in the September meeting, if Chairman Powell wanted to do something that was meaningfully divergent from the market-based pricing, he would have come out with some indications of that in the weekend or week before. So odds are, it's almost certain they're going to cut 25 basis points. I think the real question in terms of the Fed meeting is, does Chairman Powell continue to endorse a shift towards accommodative monetary policy, or is he going to express some hesitation about continuing to cut rates aggressively in response to the pretty good economic data we've seen over the last couple of weeks?
Well, we may or may not. It's possible we'll get the election results by the time of the FOMC meeting later this week. I think that's on Thursday, right? Yeah. So in that scenario, would Chairman Powell change his decision based on election results?
I think not, and the Fed has to be cautious because they need to be making their decisions based upon the actual implemented policy that they see and the macroeconomic consequences of that. And we have to take basically any of this for any political rhetoric and campaign rhetoric for a grain of salt, because you don't know whether or not those policies are actually going to be implemented. While people in the markets will start to probabilistically price that in, it's not the Fed's position to start to guess at what future policy will be. If large tariffs are implemented and that affects, inflation readings, then the Fed will respond, but not until that becomes pretty clear.
What about shifts to the labor market? Would any candidate and their respective policies put downward pressure on the labor market more than the other, you think?
I think one of the biggest policy divergences is on the immigration front. And part of what has been a meaningful loosening of the labor market, the U.S. labor market, over the course of the last couple of years has been, less than college-educated workers, primarily as a result of the increase of immigration into the U.S. And so, if we have, say, a Trump administration that's going to be much more constraining in terms of immigration, or even possibly meaningfully reversing the number of unauthorized workers in the U.S. economy, that could create a tightening of those labor markets, particularly at the lower income cohorts, which could basically create a tightening of conditions and risks bringing back inflationary pressures.
You know what's interesting, Bob? Take a look at my screen here. We have here the VIX, right? So as you can see, it's been relatively flat. However, if you flip over to the MOVE index, which is the VIX for bonds, significantly higher. Why is the bond market pricing in something that the stock markets may not be?
Well, I think there's a lot of questions in terms of the magnitude of the fiscal stimulus that we're going to see, the deficits, and also whether we're going to continue to see Fed policy shift towards accommodation. And you put that all together, the sort of big questions that are outstanding, they're less about, is the economy going to be, strong enough ahead? I think that's less ambiguity there. There's a lot of momentum in the U.S. economy to maintain its strength. And the real question is there going to be profligate monetary and fiscal policy that's going to show up in a buyer's strike in the bond market. And that's really why we're seeing that uncertainty in the US bond market.
Okay, so ultimately, what is going to be a bigger impact on the markets this week, the FOMC meeting or the election?
My guess is that the FOMC is going to be a more meaningful impact, and not just like on one particular meeting. I'm just saying the Fed's impact on the financial markets is likely to be much more substantial over time than the presidential election, because there's all sorts of constraints that exist in the president's ability to actually execute policy or campaign rhetoric that they're saying. And so if the Fed continues to endorse over easy monetary policy and a shift to accommodative policy, despite the fact the economy is pretty strong, we're going to see a continuation of the story of a very hot economy, juiced by a continued easing path by the Fed. And that's going to favor stocks and gold relative to bonds.
Yeah, well, let's talk about gold now. So gold hitting new all-time highs yet again. It's interesting. Let me just flip over to a chart of gold so we can take a look at this together. It's interesting how it's also moved pretty much in tandem with risk assets like stocks, as well as also the DXY, the dollar. Ever since basically the beginning of October, they've both been moving up together. Now, the dollar has been following, I can show that chart in just a minute, but the dollar has been following the 10-year yield. So that's a separate issue. But more or less, gold is just reacting to what exactly? Because in the past, the dollar and gold have held a pretty consistent inverse correlation, I would say. And we certainly don't see long periods of sustained positive correlation between gold and stocks unless the Fed eases.
Well, I think the correlation between stocks and golds and the negative correlation to bonds is really giving an indication of that sort of over easy monetary policy. It's pretty unusual that a central bank would cut in response to inflation above the mandate, growth running at roughly 3% for an extended period of time, and unemployment at or close to multi-decade lows. But that's the situation that we are in, and that overstimulation in the economy of the economy by the Fed necessarily leads to stocks and gold's hard assets essentially outperforming soft assets, which are bonds. I think the story with the dollar is a little confusing because part of what is drawing capital flows into the United States is the fact that the U.S. economy is stronger than the rest of the world, and U.S. yields are higher than the rest of the world. And so for now, you're getting that dynamic where the Fed is easing aggressively and somewhat counterintuitively, the dollar is rising as capital is flowing in to take advantage of stronger U.S. growth and higher yields.
Right. So gold, is it signaling something that's going to happen with either the financial markets or politics, foreign policy? Why is it so strong?
Well, I think what it's giving an indication of is the fact that monetary and fiscal policy in the United States and across the developed world continues to be far too easy relative to inflation risks and the underlying economic conditions of those economies. And, tack on China, which is engaged in an aggressive easing cycle. And basically, we have a global coordinated easing into a global economy that's basically running at about 3% real growth on average for the last couple of years. This is not an economy. We have a financial crisis level easing that's occurring in the global economy at a time when we have nothing like financial crisis like economic conditions. And so, fiat currencies between each other, the dollar and the euro and the yen, et cetera, those will trade based upon relative to conditions. But what gold is telling you is that that all fiat currencies are going down meaningfully in hard currency terms.
But why would that be if inflation, the rate of change of prices, is going down?
Well, I think the question is the monetary policy appropriate given the economic conditions, and does this create longer term risks that we have a reacceleration of inflation? I think that is what is being sniffed out by gold in particular, is this real question of does there have to essentially be fiat monetary debasement that's going to occur across the developed world, both because debt levels are so elevated and because monetary and fiscal authorities aren't willing to do the work that's necessary in order to tighten the belt and take the economic pain to bring those deficits in line.
Right. So bottom line, then gold is sniffing out a return of inflation. Is that what you're saying?
That's right. I mean, it's sniffing
Okay.
out a return of inflation, or said differently, devaluation of fiat currencies relative to hard assets.
Yeah. By the way, the 10-year break-even inflation rate, I'll put a chart on the screen for the audience, has been going up as well. So the markets are sniffing out overall. The bond market is sniffing out higher inflation, or maybe just higher economic growth overall. So that certainly makes sense. Bob, would you be shifting your portfolio allocation at all after the election, depending on who wins?
Yeah, for sure. I mean, I think the question is basically comes down to what is the highest probabilistic policy that we're going to be seeing as a function of who gets elected, and it's not just who gets elected a president, but also whether divided government occurs. And so we could easily see a circumstance where there is, if Trump gets elected, that's probably the most impactful dynamic because he's likely to there's a much more higher probability of a red sweep in the U.S. So he would control all three chambers of the U.S. government, and there's a higher probability that he actually implements his policies, which are tariffs and restricting immigration, both of which can be done whether he has Congress or not. And so in that circumstance, I think that's the very challenging dynamic for global assets because it's going to bring back those concerns, longer term concerns around inflationary pressure.
So I said earlier that we would show a chart of the US dollar versus the 10 years. So here is that chart here. As you can see, the bar line is the bar chart is the US dollar index, and the purple line is the 10-year yield. Pretty much perfect correlation all year round. So the question remains whether or not the 10-year yield is going to spike up to, I think 5% was the previous high. What's your take on yields here?
Well, I think particularly if you see a Trump election here, you're likely to and a red sweep, you're likely to see much more expansive fiscal policy and higher inflationary pressures, which could
Mhm.
easily bring that yield back up into that 5% range. The main thing I'd note is that almost mechanistically, the a rise in bond yields is going to start to create a drag in equity markets and create a drag on the economy, which essentially creates a limit to quite how extreme bond yields would likely spike in that circumstance, because then there would be an expectation if stocks are declining and bond yields are rising, that the Fed would likely respond to that by being easier than they otherwise would be, because you're getting a tightening of financial conditions that they would respond to with easing. And so while we could see that pressure elevate and see those bond yields rise in response to a Trump election, people who drew straight lines 2 summers ago to 15% or something like that, that's foolish. Like it will be a self-correcting dynamic. As bond yields rise, it will start to sow the seeds of the eventual reversal.
I wonder how economic growth and consumer spending will change in 2025, depending on who wins the election this week. Now, an argument could be made that either candidate would be stimulative for fiscal policy in different ways. So Trump with his tax cuts, he would reintroduce the Trump tax cuts of 2017. Harris has a lot of reforms on taxes that may see taxes go up for the rich. However, she wants to introduce stimulus packages for the middle class, including a $25,000 down payment for homes, first-time home buyers, for example. So housing initiatives, cost of living measures, advocating a ban on price gouging. Suppose that works, it could help inflation with the middle class. Support for small businesses. So basically startup tax credits proposed. So deducting the tax credits for small businesses, startup costs from $5,000 to $50,000. So stimulative in different ways. Would either of these help with consumer spending, discretionary spending next year?
Well, first, let's make sure you recognize that implementing tariffs is a tax hike, not a tax cut. And it's a tax hike on high propensity spenders which is basically only marginally offset by cutting taxes to low propensity spenders, meaning cutting taxes to the rich. And so that Trump's policies are likely detrimental to growth, not stimulative to growth. On the flip side, the Harris administration, even if you just extend the TCGA is already in place today. And so extending it would just keep the status quo rather than be outright stimulative. And so I think there probably is going to be some agreement around, under 400,000 extent, if she gets elected, under $400,000 income earners will have those that tax cut extended, but that just keeps the status quo. It doesn't actually create stimulation in the economy. A lot of that other stuff that you're talking about, all those various policies and plans, I think is going to be very difficult for the Harris administration to get through a divided government.
If we make the assumption that the stock market goes up under a Trump win, going back to what we said earlier, could we make the argument that due to the wealth effect, the wealthy who own financial assets could spend more if their financial assets go up in value?
Sure. I mean, the U.S. economy is highly financialized, and if the stock market continues to rally, that is definitely supportive to continued growth in the economy. The question is, when you net out these pressures, is it really going to play out that way?
So bottom line, Bob, do you see major changes to either the stock market index overall or certain sectors this week?
I mean, I think we're going to start to see the macroeconomic effects start to get priced in, presumably this week, if we get some clarity in terms of what the election is going to pan out. I think whereas say under the hood in terms of the relative sector performance, I think we're going to probably see something that looks a lot more sort of straight line in the sense of somewhat obvious sectors that should benefit from one versus the other will outperform. It's really at the aggregate level where I think there's going to be there's very likely a risk that we see a flip in terms of what people's intuitions are in terms of equity market performance, where we could see equity markets show some slowing in response to a Trump election and be buoyed by a Harris election.
Would you be more bullish in something going into 2025? Like basically your most bullish asset?
Gold.
Gold, and that's irrelevant of who wins.
I think it is pretty irrelevant of who wins, and I think the primary reason why that is if you look at assets out there, gold, the price is obviously at or near all-time highs. The issue is that it's basically totally underowned. So 99% of investors don't hold any gold at all in their portfolios at a time when it's demonstrating its benefit as a portfolio diversifier over the course of the last couple of years. As this year, it's the best performing major asset class. And the macroeconomic environment favors, gold relative to fiat currencies ahead.
Very good. Thank you, Bob. Where can you learn more about you and Unlimited?
Yeah, if folks are interested in my ongoing macro takes, check me out on Twitter at Bobby Unlimited, or clips of my work and regular macro outlooks at Bobby Unlimited on YouTube. I also have a new TikTok channel where I talk through what's going on in the markets on a daily basis every morning. So if people are into the TikTok, definitely check that out.
You don't do the TikTok dance?
No dances yet, but
right.
I do have a few bets on with some various FinTwit people.
Okay.
If I lose, you might see me dancing on TikTok.
All right. Well, I don't know if that's an incentive for us to watch you win or lose, but either way, follow the TikTok channel there. Thank you, Bob. We'll speak again soon.
Great. Thank you so much for having me.
Thank you for watching. Don't forget to like and subscribe.